Welcome to part 2 of this 10K report tutorial. Last week we looked at EPS growth. This week we're going to look at dividends. We're going to look at dividend in the income statement. This is actually going to be a pretty in-depth thing. There's a lot of intricacies that a lot of people don't realize when it comes to trying to look at dividends, trying to find them in the annual reports. And some of it can really trip you up. So I'm going to show you a couple shortcuts and show you how to pull that information from the annual reports. And there's a lot of things also you have to learn. Obviously, we're going to go over the payout ratio, talk about why that's important. That should be quite obvious. I'm going to spend a big portion of this video talking about dividend reinvestment. And, you know, you probably have heard me hound it over and over and over again. You can see this video I'm showing here on the screen. I'd suggest watching this one too, because I put like a simple example of dividend reinvestment on there. Wasn't like a realistic one, but it did kind of show the same kind of forces, the same math that's on your side when you're reinvesting dividends. So we're going to focus a big part on that. And then to follow that up, I'm going to show you how to apply that, right? Because there's a couple things. It can be hard. There's a lot of stuff that you kind of need to buy out there if you want to use some of these tools to look at stocks that have grown their dividends for a very long time. So I'm going to show you a couple tricks on how to kind of bypass that and how I'm able to pull up ideas with these stocks that have grown their dividend a long time, because it's one of those things right now with the way the internet is. It's kind of hard to find that data, and it's not easy to source it really quickly. So I'm going to show you how to do that. It might piss a couple of people off. Dividends.com might get pissed off, but I don't think they'll come after me, and let's hope they don't. So let's start with the income statement, which is where we will find the dividends. So if you remember from last week, we're going to pull up a 10K from sec.gov. That's where you always want to start. And the thing I love, so I'm on the computer at work. I'm on this computer. I have one of those tablets that kind of looks like, it kind of works like a computer because it can attach a keyboard next to it. And man, like my fingers just get so confused. I don't know how to type anymore because I'm using 3 different keyboards. So, okay, real quick, we're going to look at Microsoft. It's one of the biggest dividend stocks out there right now. You type in the ticker, you go here, 10K, and then you're going to find all these filings with the 10Ks, and each of the filing dates are going to be on here, 2017 down. So we're just going to take the latest one. You click on Documents, and this here is where you'll find, I didn't mention this last week, and I should mention it now. Most of the time, the annual report data is going to be right here in section 1 where it says 10K. Every once in a while, and don't ask me why this is just the way it is, so go complain with the CEO at that company. But like Hormel, for example, ticker symbol HRL, they put all their actually consolidated, audited results on a EX13. So sometimes if you can't find the data in the 10K, you got to look there. And really there's no good way of knowing that until you dig into the 10K, figure out, I can't find the data, and then you look here, and then you say, there's an EX13, and then that's where they put the audited data. And a lot of times they'll make this size better, so I don't know if this is like megabytes or what this is, but something to keep in mind. Luckily, we're not going to deal with anything like that today. So I'm going to use my usual trick, consolidated balance sheets. Control F is to search for that word in the document, and as you can see, we're actually not getting, it's not pulling us to the consolidated balance sheet, which is where we need to go. So again, another instance of, well, this business must be reporting their annual reports in a different way. So let's try consolidated statement of, no, usually I say of income. That didn't work. Let's just put balance sheet. Yep, and that's what they did. Okay, so looks like they put it in item 8, which is where it usually is. And they didn't call it consolidated, which is kind of frustrating. Hopefully that's not a trend that's going to happen in the future. I'm sure if we read these notes, they would say that, yes, this data is audited. If you're going to do a company analysis on it, make sure that's the case, because usually, almost all of the stocks I've seen, they all say consolidated, and that's how you know it has been audited. So keep that in mind. Obviously, this is just an example, so we're just going to leave it be for now. Okay, so we're here in the income statement. You remember that from last week with the EPS growth. Remember, we have top line, which is just revenue. That's the money that's coming in. And then the cost of revenue, it's going to be part of the expenses. There's going to be gross margin, all these other expenses. Then you get to the bottom of it right here, net income, and that's your bottom line. Those are profits. Now, from these profits is how a stock pays a dividend. And that's going to be important in a little bit, and we're going to talk about why, because just because a stock pays a dividend doesn't necessarily mean it's a good thing. There are healthy and there are unhealthy dividends. There are smart and unsmart dividends. So, as you can see here, we have the rest of the stuff that we need: EPS and average shares outstanding and dividends. So here we are. There's the dividends. You can see they've increased every year for the past 3 years. I wanted to pull up another case because just like some of the other stuff we talked about with the annual report can be different, so can where the dividends are in the annual report. And this is frustrating as well, I know, but this will be a helpful tool for you as well for when you're looking for this kind of data, when you're filling out and making your own analysis. So I had to go through several different stocks to find this where it was the case. Went to Visa because I was like, well, they have a low dividend yield, so maybe they're trying to, hide the dividend, right, or not put it in their income statement because their yield's so low. And funny enough, that actually happened to be the case. So go to my usual consolidated balance sheet technique. Here we are. Okay, and then usually the income statement's either above or below the balance sheet. Here they call it statement of operations. Again, don't worry about this stuff, how the naming's sometimes different. You can see revenue still on top. Earnings, net income still going to be on the bottom. So don't get discouraged when some of this stuff all has different names and different ways of finding the names. You just have to do enough of these, and then you'll be like, oh, well, this means this, that means that. You can see here there's no dividend paid, right? There's no dividend per share. So one way you can search is just an obvious Control F dividend. You can see there's like 43 different results, so that can get kind of frustrating. My trick is I go market for. You can see in the table of contents, item 5 of every annual report, they have market for whatever all this junk is. And what that reports is the price ranges of these stocks, so where they traded in each quarter, their highs and their lows. And they also almost always put the dividend data below this quarterly stuff. So we can just see here, okay, 2017, they paid 4 dividends, 1 per quarter, and they were 16.5 cents each. So if we wanted to calculate the dividend for ourselves, we would just multiply that, and boom, there's our annual dividend, 66 cents. Let's go back, and this was for ticker symbol Visa. But let's go back to Microsoft, and let's do, again, a couple of simple, easy ratios to make sense of the dividend part of the 10K annual report. First one is obviously just the dividends per share. And if we do, let's say 2017, 2016, 2015, you can see, hey, I'm starting to use the keyboard. What up? All right. Let's just put this stuff here. And like all this count. So, couple things that we can calculate. The first one that's going to be important is dividend yield. Dividend yield is going to tell us if we buy the stock, this is how much yield it's going to give us in dividends. Should be straightforward, but basically, if I'm going to put $100 into this stock, and if the yield's 3%, then that means I'm going to get $3 per year in dividends, assuming the dividend doesn't go up. But a lot of times these companies do raise their dividend, and that's obviously great to have. So that's where the dividend yield comes in, because everybody's going to be investing differently, and stocks are all different sizes, and so on a per share basis, all this stuff, it's all different, it's all subjective. But when you have yield and it's a percentage, you know that no matter how much money I'm putting in, whether it's $10 or $10,000, whether the stock is a $1 billion stock or a $100 billion stock, a 3% yield means I'm going to get a 3% payment on my stock. So the way to calculate this is you want to get the actual share price, because that's how much it's going to cost to buy right now. So if we went to Microsoft, look at that. They are currently $95.82. So the yield is just simply this divided by this. And just remember that logic, okay? This is how much we're going to pay for the stock. This is how much we're going to put in. So for each share, they're going to pay us $156. So if we know one share costs $95, one share will pay us $156. You just divide the $156 by 95, and you understand that's a 1.63 yield. So if I were to invest $100, I would be getting $1.63 in a dividend. Next thing that we're going to want to calculate, and this is important because it tells us whether the dividend is safe or not, and it's the dividend payout ratio. Basically, like I said, these companies will take dividends out of their earnings. So if there aren't any earnings to take out of, then the company is going to have to take on debt or use some of their cash reserves in order to pay the dividend. And so they can do that, maybe a year or two, but they can't continue to do that indefinitely. And so it's a sustainable situation. You want to try to generally avoid those types of situations as much as you can, because it's unsustainable. And so you would either need something miraculous or some sort of rebound for this company to all of a sudden be able to pay the dividend, or they're going to have to cut the dividend. And guess what? When the dividend gets cut, shareholders tend to flee for the hills like crazy. So don't want to get stuck in that kind of a situation. And the payout ratio is a calculation to help you not get stuck in one of those. So what we need to include here is the earnings per share. And you remember from last week, if you didn't watch that, go watch it. It's part 1 of the 10K report tutorial. I'm putting these all in an easy playlist to follow. But, we want the diluted earnings per share, and we covered that extensively last week. So we're just going to put that to 2.71. Okay, and then the payout ratio is going to be really simple as well. And it's just going to be the dividend divided by the earnings per share. Because remember, we're taking the dividend from earnings per share. Now, we're at 58%. So the thing about the payout ratio, anything above 100%, and that's what we call unsustainable. Something big is going to have to happen. So they're going to have to really increase their earnings next year or cut the dividend, But basically they're going to have to, if they want to get under 100% payout ratio for next year, if this year's 100% or more, they're going to have to really kick up those earnings. So I always avoid any stocks that are above 100% payout ratio. I haven't bought one up to now that's had one of those things, so keep that in mind. REITs, REITs, just on a side note real quick, those are required by the law to have a certain percentage. So they're going to be high, like it's 70, 80, or 90%. I can't remember. And so that's not a bad sign. But, the closer you get to 100%, the more kind of risky that this stock becomes, because, okay, you obviously shareholders like to see dividends increasing, and so if the dividend's increasing faster than the earnings, well, it's the earnings are going to run out eventually. And so you want to look for that, and you want to look for, if this was 99%, well, we're looking real close, and we're going to have to match the dividend growth exactly, and there's no margin for error. It's going to really have to hit those earnings numbers, or else again we're going to hit a payout ratio that's over 100%. And a lot of other investors really don't like high payout ratios, especially dividend focused investors. So it would really hurt the company to not respect that. So let's do one more thing with this. And for yield, anywhere from 2 to 3 tends to be average. 4% is considered pretty good, and 1's like decent. It's not necessarily terrible because yields can grow over time and stuff like that. So kind of keep that in mind. 4 and 5 and up are really considered really high. Just for some background. So let's fill out the rest of this, and I want to show you one last thing on the Excel spreadsheet, and then we're going to move on to some of the real important stuff that will be very applicable to you if you're going to be a dividend investor at all. So obviously this can just be calculated moving forward, and let's use our special trick again, market 4, and let's just pick a couple of these share price numbers, right? So here, 2016 for that's nice. They have it for us for the fiscal year. I'm just going to take the high just for simplicity's sake. Or, let's not be lazy. Let's take the average of the two. That, this is what I talk about, or this is why my VTI spreadsheet is formulated this way. Again, another side tangent. If you are a value trap indicator client, you understand what I'm saying. But that's how I calculate for if you're going back in history and you're trying to calculate old share prices, old value trap indicator scores, this is the way to do it. And, you put the high and the low and you calculate the average, and that's going to give you a good kind of representation of how that quarter went for the company and the stock. Let's take something at random for 2015. 48, what was that? 48, 42, 45, 43. All right, so we see, the yield's kind of fluctuating. And you see the payout ratio is decreasing. You see that? We went 84, 69, 58. And so actually, that's really good. That means that Microsoft's, because that's what we're looking at, Microsoft's earnings are increasing, and they're still increasing the dividend, but they're increasing it not as fast. So now they're able to get to a more conservative payout ratio rather than before where it was very aggressive. And again, like I said, they had a little margin for error. So that's really cool. It's cool to see trends like that. The dividend yield is really going to fluctuate like crazy, so don't put any emphasis on how this moves from year to year. The lower a stock price will go, the higher the dividend yield will go. So it's another kind of advantage of using value investing, because you get higher yields because you're buying low and you're buying companies that are out of favor with the market in general. So that's something to keep in mind. But really, track how the dividends per share are moving per year and track that payout ratio if you want to see what direction they're going in as far as that health of that dividend and how strong their business is. I mean, there's a couple other ways you want to look at for the strength of the business, but this is one great way to start. Now, on the topic of increasing dividends per share, I really want to really make you understand, make sure that you understand why dividend reinvestment is so important. And it's so important that I'm stumbling over my words to get to the topic. But the way I want you to picture it is it's like a family tree, okay? When you reinvest a dividend, you are essentially giving yourself, I liked one of the metaphors I used in one of the previous daily emails I did, and Dave was cool. He gave like the upside down family tree, or what do you say? No, upside down pyramid scheme, right? But look at how it's like a family tree, how like it just kind of grows out. So if you think of each dividend as each little branch, and so each new dividend is able to make even more, and then this new dividend that came from this dividend is going to make more dividends down here, and on and on and on and on. And in the daily email, I kind of use the metaphor. It's like you have your little workers, and they can work on the farm, and then they can reproduce, and you know, at the beginning we're looking at 1%, 2%, 3% yields. It's nothing to really get excited about. But as you go on, as the years go on, all of a sudden, this is this is a terrible example because their family tree is really small. But imagine this one branched out like a regular family tree, branched out, and so by the time you get down here to like the 5th level generation, you just have multiplier effect like crazy. And that's how dividend reinvestment works. So keeping that in mind, let's not only think of it conceptually, but let's get some cold hard facts, some data. Let's do that. So go on my website because I had a nice little article about some of these stocks that had crazy good dividends and dividend reinvestment and compounding. So I took a couple of case studies and I wanted to see what were some similarities between some of these and just how great did they become. We're not going to focus so much on the characteristics today because that's kind of more of a stock selection idea, but I want you to see 1987, basically 30 years ago, had Walmart, Coca-Cola, Abbott Labs, Altria, and Procter & Gamble. Putting just $10,000 in each company would make crazy returns, okay? I mean, first off, look at the annual dividends. Yeah, I think Walmart, what did they start off at? They start at 0.44%. So you put in $100 and you're getting 44 cents for a dividend. Whoop-de-doo. But it grows over time. You're reinvesting over time, and so it's all blowing up just like the reverse family tree with family members that are getting active. And you get now all of a sudden what they call it is a yield on cost, which is basically the yield on how much that investor put in originally. So they put in $10,000. Now they're getting $1,000 every single year, and that's 10% of what they had put in. But they're getting that every year, and they're not having to touch it. They're not having to put more money in, nothing like that. And the actual total value is just ridiculous. Tell me where else you can exchange $10,000 and get almost $200,000 back. I think everybody would sign up for that. Yes, please. Thank you very much. So these were the 5 companies I found in this blog post. It was very cherry picked. I just took some of the 5 names that I knew were great dividend picks. But I also want to show you in this video how it doesn't, necessarily, just because it was cherry picked doesn't mean that these are like outlier cases. So like another example of this is if you look at, and this is something that's super key too, okay? Before I move on, we will talk about this a little bit. So let's talk about the takeaways just real quick, okay? Dividend yield didn't matter. I kind of already covered that, showed you with the 0.44 with Walmart. Secondly, it's never too late to catch the train. So each of these had growth histories already of 10 years or more. So what we're talking about here is consecutive years that a stock grows the dividend. And there's different terminology you'll start to hear as you get into the dividend investing world. I believe dividend aristocrats are considered 25 years plus. Dividend kings are considered 50 years plus of growing the dividend. And I don't think there's a name yet for 10 plus years, but it's definitely searched for a lot. And it's definitely like this cutoff point where you get like this unspoken reward as a stock when you hit this 10 years of consecutive dividend growth. And I think, this is just my personal non-scientific opinion, but I believe that stocks really get a bump once they hit that 10-year range, because now all these dividend investors that really focus on dividend growth, they all start to pile in. And then once you get that momentum train going, then the technical analysis guys jump on the stock, and then it can really start to take off. So you'll know this with each of these. These are how many years, and this was 30 years ago. So, these are all stocks that they're considered old now, but they were still considered kind of old back then too, like Walmart. For 12 years, they had already been growing the dividend. So it wasn't like you were buying at the IPO. You were buying after they had lots of success for a long time. And so it's never too late, right? Coca-Cola, they had 24 years before that. Abbott, 14. MO, 17. And Procter & Gamble, 30. And each of these continued for another 30 years to grow. So now Coca-Cola's at like 54 years. Walmart's at 42 years. So why I mention that now is because let's look at exactly what I'm talking about. That group, that special group, the stocks that grow, they have grown their dividend already 10 consecutive years. And so because we understand that that doesn't mean it's too late, that we can still get on these and they can still continue for maybe the next 10 years, 20 years, 30 years, or even longer. So why not search them out? Why not find them? Why not use them as reference points when we're trying to pick the next stock pick? So let's search 10 years of, there you go. I already searched it, so this makes it nice and easy. Now, this is the trick I want to show you too. Nobody tell Dividend.com that I'm telling you guys this, okay? So here's their list, right? Pretty cool. I think they update it pretty frequently. Lots of stocks. So plenty of stocks that we can look at that have great track records. And, a great track record doesn't guarantee that we're going to have a stock that continues its great track record. But, it's better than investing in stocks that don't have great track records. And what's Einstein's or Newton's law of what's in motion stays in motion. So that does happen in the stock market and in the business world. And it makes sense, once a company has an advantage, why not continue to compound on it? No pun intended. So, we'll get to this a little bit later, but keep in mind that, they don't let you export this. They want you to pay to export this to a spreadsheet, but I'll show you how to get around that. So real quick, let's, before you accuse me of just cherry picking these and, these are the best and these are outliers. Let's do a couple more then. I think these stocks that have long growth histories, they're paying dividends, and they pay dividends because they have a lot of earnings. So to me, it only makes sense. Well, yeah, when you have stocks that pay and grow their dividends, it's going to attract shareholders, and they're going to be usually better investments. Why is that such a mystery? I don't ask me why. Let's do one of these. This is a super cool tool. I'll link it up in the description as well. But you can use it to see if you held the stock, if you reinvested the dividends, how much money would you have had? So let's take one of these at random. Let's take the top one. They've been growing for 63 years. AWR. And let's go 1987, 30 years back. And don't forget here, you want to do annual because this will take forever if we don't. So what does $10,000 become? 10,000 becomes 352K. I'd say that's pretty good. Let's take, I don't know, Medtronics, MDT. Look at that for 30 years. 10,000 would become 813K. So, I mean, once these guys have their 30 years of service in, let's do T-Row. Once they have those in, they're becoming fantastic investments. 10,000 becomes $1 million. Okay. So, that's the thing. You want to find these stocks that will continue to get up, because I'm looking at stocks 30 years and higher, right? This is the number of years they've consecutively increased their dividend. So I want those because we just saw they have fantastic numbers over the long term and continue to reinvest those dividends. That's all the compounding that I was telling you guys about that you're probably tuning out, but that's okay. So, that's why we want to find these up and coming stocks that are going to hopefully be able to continue that. And using the payout ratio like we did here is one great way to kind of help, not guarantee, but help your chances that the stock's going to be one of those. Some of the other stuff we'll cover in later tutorials will also help with that. But now we know that, and now hopefully I've really seriously convinced you that dividend reinvestment is super important. Let me now finish this tutorial by saying, okay, well, let's take this list and let me show you how you can start to sort through these, and maybe, you can pick up one of these that are near the bottom that are around like, 11, 12, 13. We pick a couple of these that are starting on that long 30-year, 40-year journey. And, not all of them will continue on, but if we can get a couple of them in there, I mean, why not take 10,000 into $1 million? That would be fantastic. And I think when I talk about the dividend fortresses in my e-letter, that's really what I'm focusing on. That's what I'm talking about, is this kind of a thing. This is what we're going to try to do. So I made, because so I'll show you this real quick, and then one last visualization, and then we'll finish off with the final trick. So, this dividend.com, they tell you can't export it. This is how I do it. And you try to do this in Excel, it's not going to work, so don't even try. I already tried it. So you copy this, Control C, and then I'm just going to show you right here so you don't think I'm just cheating. Just delete all this. Now you go here. This is a Google Sheet. Paste special, values only. Bam. Because if we try to do a regular paste, it literally pastes. Oh, I guess that works too. Okay. Never mind. Well, I guess Google Sheets works. Excel doesn't. It just, if you try it in Excel, it just literally blurts, puts it all into one cell, and it's just not helpful. So I just helped you get away from this little dividend.com premium stuff. One last spreadsheet, and then we'll use this data to try to narrow down some ideas for stocks. This is a spreadsheet I made a while ago, and I still use it today when I'm kind of looking at different dividend opportunities. It's a non-reinvestment versus reinvestment hypothetical. So let's say you got a stock, it's $100. Let's say you're putting $1,800 a year into it. So you can see in year one, you're able to pick up 18 shares. That's going to be, the basis of how we're going to go through this little simulation. So in year two, and this is, I'm assuming a 10% growth on the share price and on the dividend. So you can see from year two to year one, it went up to 110 from 100. So that's a $10 10% increase. Here it went up 9 cents. That's a 10% increase. So everything here on the left side is as if you never reinvested. This is if you actually reinvest your dividends. So I'm just going to show you this stuff here at the bottom because this is so cool. By the end of 40 years, without reinvestment, you still get nice compounding because the stock's continuing to grow 10% a year for a long time. You're almost at 800K. But for reinvestment, you're at $1 million. That doesn't sound like a lot, but this is for a 0.9 yield. That's kind of small. Let's do a 3% yield, which is kind of more near the average. Not average, but one that's kind of targeted. And now again, it's this. I guess it's the same because we're spending all of our dividends in this non-reinvestment, so we're not picking up any additional shares. At the end of the day, the stock's gonna compound at 10% a year, And so, that's how much we'll have. By the way, this spreadsheet is assuming you're putting 1,800 every single year. I did like a dollar cost averaging thing. Okay. So you're at 800K, but now if you had reinvested, you're at almost 2 million. So more than double, almost triple the amount over 40 years if you reinvested. And so you can see, again, it takes time. See, after 5 years, the reinvestment guy has 5 more shares. Just 5. And so, just maybe, what is this, $1,000 more, not even. But then over 10 years, now they have 20 more shares. Now they have 50 more shares. You see how it speeds up. It's an exponential growth. That's compounding. It speeds up. It's multiplying on multiplying on multiplying on itself. And so it's so powerful. Now, let's say, I don't want to individually go through every single one of these stocks and their 10Ks. But I want to be able to narrow down and see which ones are trading at decent prices now, right? Which ones look like good opportunities that we can maybe investigate further. Did you see that? I'll show you guys again. So you go to finviz.com. This is my screener website that I prefer. I mentioned this one on, I won't go to it, but a couple videos. One of them, I talk about how to find great ideas for dividend stocks or how I find them, and Finviz is how I do it. You can definitely look at that one if you want more of an in-depth tutorial on Finviz. I should be a good YouTuber and actually figure out which one of these videos I'm talking about. So it's this one here, my exact method of finding great dividend stocks. That one I use Finviz. I think I go more in depth on that. And this Peter Lynch one too, I just released it a week ago. That one is really in depth on Finviz, and that can help you out as well. So I'm just going to go through quickly because this is running pretty long. But you take all those stocks, and you can stop here, right? So it's like, well, maybe I want to find an up-and-comer, one that hasn't grown for its dividend for 60 years. Let's try one that's 20 and below. So then you could just select this group and then copy paste it over. But I'm just going to do the whole one for now. So hit copy on there. Now we go to Finviz. You go to screener. You see the 7,300. That's how many stocks that they have data on. I always like to narrow it down to S&P. And then what you can do here as a filter is you can copy paste all the tickers that are on a list. So these are all the tickers. Bam, look at that. So some of these, actually a lot of them aren't in the S&P yet, and those can be great values too. But just for the sake of this, let's just look at that. So we're at 95. Now I know I can start to do filters here okay, I want a decent PE under 30. There we go. But I know everything on this list are all stocks that have grown their dividends 10% or 10 years consecutively or more. So that's going to be, if you're looking for dividend growth, if you're looking for dividend fortress type stocks like I love to buy, if you're looking for stocks that you're going to hold with the ideal holding period of forever, and you're just going to continue to reinvest dividends and hope that these stocks continue to grow their dividend and you can continue to pick up shares, this is a fantastic place to start. And I think it kind of wraps up the whole dividend tutorial part perfectly. So now you know how to look it up on sec.gov, how to find out, how to pull out that important data. And, now that you have a list like this, start to go through, start to narrow it down with some of the stuff you like to see. Maybe get a list of 5 or 10 and then go back through again. Go back to sec.com again or sec.gov again. Put those tickers in there. Now look at their annual reports. Start to fill out a spreadsheet. I have value chart indicator spreadsheet that I offer, but you can make your own spreadsheet. We've made our own here, right? So start to do that. And then now all of a sudden you're going to really give yourself a great place to find great ideas, to find yourself in the right stocks, to be analyzing great stocks. And it's just your chances of success and your chances of finding those type of stocks. I feel like a lot of people that get down on dividends and dividend stocks, haters. They always say that, there's survivorship bias, and like they make it sound like these stocks that will compound your wealth really fantastically, like they are some sort of unicorns. But I mean, look, like I really challenge a lot of people to go through here, use like a stock return calculator like Stock Upside and see over long enough time periods. It's just that consistent habit of these companies paying a dividend and growing them just compounds so powerfully that, even if they aren't necessarily the best businesses, they still compound capital fantastically. And then maybe you do find a unicorn. Maybe you do find like a Walmart or, um, Coca-Cola or Procter and Gamble or T Rowe, and how many losses is that going to make up for? A hell of a lot more. And, if you're cutting your losses short and getting out of stocks when they stop paying dividends and stuff like that, well, now you're protecting your downside as well. So just so many ways to kind of look at this. And I'm obviously super passionate about dividends. I know I talk a lot about value investing, I talk a lot about getting into the financials, and I'm obviously super passionate about that too. But this is like the other side that's just as critical, in my opinion. So you usually have people either in one camp or the other, and I'm just like crazy in both, in my own way. Don't kind of a contrarian in that way too. But anyway, from here you're gonna have three options. Firstly, thanks for watching this. As I'm recording it right now, I'm doing one tutorial every week. So this 6-part series, we're going to do 4 more every Saturday. One's going to come out. This one's coming out on a Saturday. So stay tuned for those. Subscribe to the channel if you want to be able to watch those. We went over EPS growth, was income statement. Went over dividend, which is income statement today. We're also going to go through balance sheet and cash flow statement in the future, so stay tuned. So that's your option. Subscribe to the channel. Click on the bell if you want to get notified, and you can watch these videos right away as they come out. Your second option, subscribe to the email list over at stockmarketpdf.com. You'll get a free ebook. You'll get daily tips from me. You'll hear me and my thoughts, my passionate thoughts on investing in the stock market and how I can help you, the beginner. And number 3, check out the playlist I created on the channel called How to Analyze a Stock with Valuations. It's a very, very helpful resource. I actually have it pulled up here so you can look. Yeah, there you go right there. I already mentioned one of them, the whole dividend stocks using FinViz. This is more of kind of the same stuff we're doing with the tutorials here, but just a in-depth look at some of the ratios that you'll need to use and why they're helpful, why these metrics are helpful. Because on top of learning how these metrics work and why they're helpful, why they make sense, I really try to also always give like real-life examples. Hope I did that plenty today. I definitely did it in some of these past videos as well. So feel free to check all of that stuff out. I think I'm going to call it a night. Remember, stop working for money. Put money to work for you. Thank you, and I'll talk to you next time. Peace